Commodities, let's get back to equity markets and talk to another corporate. MPS saw its revenue from operations surge 38%, EBITDA rose 32% on a YY basis. The margins came under some pressure. To discuss this and more, we are joined by Rahul Arora, who is the chairman and CEO at the company. Mr. Arora, good morning. Thank you so much for joining in. Well, your revenue growth in first half was 37%. You had guided for a 25% revenue growth in FY25. Do you think there will be an upward revision to the guidance? And also segment-wise, you've done better than the guidance that you'd given. In the content biz, the platform business has seen a substantial growth. Is there possibility of upward revision to segmental growth as well?
So thank you for having us on your platform. So a couple of years ago, we articulated a fairly bold vision that we want to get to 1,500 crores in revenue at similar margins by FY28. And while I'm not super thrilled to keep reporting progress in that vision, I think we are all working really hard at MPS to make sure that we reach the halfway mark on the vision by the end of FY25. And that's really our focus right now.
So will you exceed that guidance, or it's going to be 25%?
So again, we're gunning to do our best. Not comfortable sharing specific guidance, but we're gunning to do our best. And things are looking good, as you can already see from our results.
Okay, Mr. Arora, when we are talking about the EBITDA margins, there's been quite a significant dip on a year-on-year basis, almost 500 basis points compression. Now, despite the higher top line, typically in your business, don't you see operating leverage, benefits that does kick in, or is it because of a weaker mix that we are seeing a compression as far as margins are concerned?
Yeah, I think if you dig deeper, the margin erosion really happened back in Q1, and largely because of an acquisition that we did earlier this calendar year in March, which was a loss-making company, which we very quickly turned around. So going Q2 onward, our margins have come back on track and only perform better from here. So we had an extraordinary event where we took over a company that was loss-making, have quickly turned it around, and from Q2 onward, we're back to our old margins of north of 30% EBITDA. So the suppression really just took place as a one-time event in Q1.
So FY25, will you end with 25% margins? Because I believe that's what you had guided at the end of Q1.
So again, our goal is to get back to the old levels of margins, which is north of 30%.
Okay, so that will happen in FY25 itself?
Again, I'm not thrilled about giving tight guidance that way, but in the long run, yes, we want to be at the 30% or 32% range.
But you have given guidance in Q1. What is stopping you from maybe reiterating that or changing that right now?
Yeah, so there is no change to the guidance. The business is doing really well, as you can see from our quarterly results. It's just that, as a board, we've reconsidered this approach to giving quarterly guidance based on feedback from several minority shareholders. And therefore, we're focusing on FY28. And again, there's no change to our approach. The business is doing really well. We had a wonderful Q2, wonderful first half of the year, and that progress will continue to the rest of FY25 as well.
Okay, Mr. Arora, so, in the first half of the year, if you're looking at, the indicative guidance that you had given of close to 25% revenue growth, you've managed to achieve almost 37% growth. So are you expecting some moderation as far as H2 is concerned? And even when it comes to, margins, 26.4% is what you achieved in H1. So again, some further moderation expected, and will it also be because of the recent acquisition?
There is no moderation, only optimism ahead. Like I explained, the erosion that had to happen is in the past, in Q1. So there is no moderation, only optimism. And going forward, things are looking really good. Q2 is a start of something very big. And things will only improve from here. There is no moderation.
Okay. A significant portion of your newly acquired AGE's revenues, they come in from China. The company projects that China will contribute around 15 to 20% of consolidated revenues going forward. What is the current geographical split? How will China contribute going forward to overall revenues?
Again, as you described, so we're not just seeing this as a China opportunity, but rather an Asia-Pacific opportunity. So Asia-Pacific now is 26, as per Q2, 26% of our revenue, and almost north of 35% of our PBT. So as a region, Asia-Pacific has become increasingly more strategic and important to us. And the large reason for that is while the market from a total addressable market standpoint is smaller compared to the Western markets, the growth rates are much higher. And we're essentially capturing on those growth trends that we're seeing in the market. So if I have to take a guess, Asia-Pacific as a total percentage of revenue will only increase from here, given the overall macro trend that this market is growing much faster than some of the Western markets.
how much faster is it growing? If you can give us a sense of what is the growth in other markets versus Asia Pacific, which makes you so confident or bullish on this particular geography?
So if the global market, e-learning market is growing at 10-11%, Asia Pacific is growing at 15-16%.
Okay. Want to understand one more thing. Revenue mix currently largely skewed towards content solutions. So by the end of next year, will that continue? Right now, we believe over 50% is coming in from this particular business. So end of FY26, how do you expect the revenue mix to pan out?
So while we look at our business, when we report our business in segments as content, platform, and e-learning, we actually attack the market as research, education, and corporate. These are the three markets that we attack, and then content, platform, and e-learning is simply a toolkit to acquire market share. Having said that, if I had to make an educated guess, in the long run, it'll probably be a third. And the reason I say that is we are intuitively seeing that the platform play and the learning solutions play is growing much faster than the content piece, as well as a lot of the inorganic considerations that we're making on the acquisition side are either some form of platform play or some form of learning solutions play. So, in the long run, I think they'll be equal with much of the short-term growth coming in the platform and learning solution space.
Okay, all right. So that's the plan going forward. Thank you so much, Rahul, for joining in today. And season's greetings to you and everyone at MPS Limited.
Thank you so much.
Okay, on that note, we'll slip into another break. When we come back, we'll discuss market technicals with Midesh Thakkar, talk about top trading bets as well, and a lot more. Stay tuned.